You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Well, a hectic day on Wall Street, to say the least. Markets going down, stocks that have no earnings going up. Earnings announcement across the industry have about a third of the S&P 500 index is going to be announcing earnings over the next couple of weeks. The FANG stocks are jumping into the quarterly earnings reports. So I should let you know that we are taping Options Playbook Radio on Wednesday, January 27th. The markets are closed. Now, pretty much all day long, all of the financial media, including a lot of the big financial networks, have been talking about stocks like GameStop, which is up a ludicrous amount in the last couple of weeks. There's been enough fodder about it that I'm just going to acknowledge it, and then I'm going to move on. I think that I want to talk about some companies that are announcing earnings. I actually would like to look at Apple. We actually looked at Apple on the Monday stock play of the day, which you can watch on the Ally YouTube channel. So going into earnings, we talked about Apple. Right now, they should be announcing earnings. I actually don't know exactly if the stock is up or down, but they should have announced by the time of this taping. Facebook is also announcing. But next week, we have something a little different. Alphabet and Amazon are announcing on a Tuesday. And it's been many quarters that they have usually announced on a Thursday, which when they're expensive stocks like that, it makes it very interesting trading because you have one day for that stock to move after earnings before those Friday option contracts expire. So this week we have it on a Tuesday, and that definitely adjusts your thinking if you would like to speculate on earnings. So I kind of flipped a coin. I thought maybe I would look at Amazon, but that with Amazon being almost double the price of Google, not quite double, but $3,200 stock, and Google or Alphabet being at a $1,818 stock, I decided I would just go with the Google stock today. And we're going to look at that trade. Now, we will not tape a show before the earnings report. And because of that, we're going to talk about a skip strike butterfly in Google, and we're going to be able to go way out of the money to do this trade. And because of that, I probably wouldn't look on putting on the trade this week. I would probably wait till next week. But as I mentioned, they're announcing on a Tuesday, and we usually tape Options Playbook Radio on a Wednesday. But I do feel like I usually will look at either one of those two bigger stocks in the FANG family to actually do a trade on. So as always, when we look at these trades, we're just looking at specific conditions. And the skip strike butterfly is real interesting in that you can just really get way out of the money on a lot of these things because the market volatility, well, the VIX broke up above 30% for the first time in a while. The VIX is now trading today at 37.21, up 14 points on the day. And we had the S&P 500 index down about 100 points. And the Dow Jones Industrial Average was down about 630 points on the day. So Apple was pretty flat today. Actually, it was down $1, traded flat almost all day. Kind of guess it was down a little bit going into the close. And what other stock is announcing today? Facebook is announcing. Facebook was down about 3.5% going into the close today at 272.14. Okay, so they should have announced earnings by now. Let's jump into our trade for this week. It's going to be Google. And so if we're going to look at earnings, the first thing that we always do here on Options Playbook Radio is actually look at, well, what is the expected move going out to that earnings expiration date, if you will. So, for example, Alphabet is going to be announcing earnings on February 2nd. The closest expiration to February 2nd that is available to trade is the February 5th expiration, which is that Friday. If we look at that Friday, what the marketplace is saying by looking at the long straddle is that the at-the-money put and the most at-the-money call, which would be the 1820 strike, are trading at about $70 each at the midpoint. So we're looking at $140 net debit on that long straddle. So that's doing a little bit of rounding there, but it's not an exact science when you're looking at the expected move after an earnings report. So if we look at that, we're talking just under 8% move. That's a fairly decent move. That's more than usually expected when you're looking at Google. But that's been the case with a lot of stocks, mainly because the added volatility of the marketplace overall. So we're looking for about an 8% move. But ideally, if you look at this going out in time, the biggest thing that we see here is that we can get quite a bit out of the money and still be able to do a skip strike butterfly for a decent net credit to the account. So the skew is very large in a lot of these stocks overall. We're going to go to the call side. And if I add 140 to the current price of the stock, I want to be aware of that range. I want to see what the marketplace thinks the underlying stock could go at. So if I add 140 to 1,818, we're looking at 1,958. So as I said, we're going to do it on the call side. And not necessarily that I'm bullish on Google going into earnings. It's just if I'm thinking about option pricing and I'm thinking about high volatile marketplace, and there's a lot of premium overall, if we're going to be correct on our forecast here with this trade, we need implied volatilities to go down. And they're going to have a more likelihood to go down faster on a positive announcement than on a negative announcement. Okay? So if I'm looking at this trade, we go out to that level, that 1,900, let's call it 60. We still see that actual call option trading for $26. So that's still a real expensive call option. Now, once again, we're doing it today on Wednesday. We'd probably look at this trade either on Monday or Tuesday, more likely. But right now, that's where that call option is trading. So I'm going to go even further out of the money because I can still go all the way up to the 2,000 level, which I think having a big round number also kind of helps. If we're putting this trade on, we would love the market to come to that level and go up towards our short strike. But ideally, we're doing this trade hoping to at least make the net credit. And we're going to get this trade done for a net credit to the account, which means that if the market goes down, we're still going to be profitable on the trade overall. And that's the whole goal of the skip strike butterfly. A lot of times I like to think of it as an alternative to actually selling a call spread, in that I'm doing this entire gaggle of options, hoping to bring in a net credit. And if the market just stays where it's at or drifts downward, well, then I can, all those option contracts in theory, well, not in theory, will expire worthless, and then I can receive that net credit to the account. Now, in the skip strike butterfly concept, we're actually selling a call credit spread to pay for our butterfly. And hence, a lot of people will call this a broken wing butterfly. I don't like that name. I'd rather call it a skip strike because we are skipping a strike. And when we skip that strike, we embed a call credit spread in. And let me explain that a little further. So if we did a normal butterfly starting with the 2000 strike on the call side, we would be buying the 2000 strike call with that February 5th expiration, selling 2 of the 2040 strike calls, it's 40 points away, and then buying 1 of the 2080 strike calls, and that would be done for a net debit to the account, and that would be a standard butterfly. But you can think of it as, well, we are maybe buying the 2080 strike call, and at the same time, we're selling the 2080 strike call, right? Because that's going to give us a net zero position, or we're basically selling that 2080 strike call and skipping it overall, and then going down another 40 points and buying the 2120 strike call. This is tough because there's a lot of twos in here, but effectively what you're doing is you're doing the butterfly and then selling the call spread, the 2080, 2120, 2080, 2120 call spread, and you can bring in enough credit to pay for the butterfly. And that's what a skip strike butterfly is all about. All right. Now, the thing that's wonderful about this is that we can go 40 points wide on this butterfly, still get it done for a net credit. The downside is that if you go 40 points wide, you're going to have a real margin requirement, and you're going to have real risk on this trade. We're only looking at a 1x2x1, but overall, when we do this trade, if that stock were to gap open more than the expected move, it would make you a little nervous pretty quickly. We'd prefer that it slowly went towards our butterfly, i.e. our middle strike of our butterfly is our target area, which would be 2040. If it goes too fast, it's going to hurt us overall. So it's kind of, if you look at the profit and loss graph, to start with, you're better off if the market actually goes down. But over time, as expiration approaches, you're better off if you land fairly close to the short strike of your butterfly. So it's a very odd trade, and that's hence the reason why we always say on Options Playbook Radio, you should paper trade these. You should learn how the pricing of these work. And if you take a pen and you write that down, throw that in, Ally Invest profit and loss calculator will kind of show you how this profit and loss changes over time, or wherever you want to go and check it out at. But it's a very nice feature, especially on advanced trades like this. So let's get to the net credit that we're going to receive on this trade. Okay, we're going to go to the February 5th expiration. We're not going to go any further than that because we need time decay to work for us, even if we're correct on our forecast. So the February 5th expiration is the closest expiration, closest expiration to that earnings announcement. And we are going to be buying the 2000 strike call on Google, GOOGL, otherwise known as Alphabet. We are then going to be selling 2 of the 2040 strike calls, and then skipping the 2080 and going out and buying 1 of the 2120 strike calls. The markets are closed. It is Wednesday. The markets are a little bit wide right now because they are closed, but right now it's showing a midpoint net credit to the account of $1.65. or $165. Now, our risk on this trade at expiration is going to be between, where that risk comes in is between the 2080 strike, the strike that we skipped, and the 2120 strike. Okay, so that's 40 points wide, and that risk that is generated from doing this call, that means we'd have a $4,000 margin requirement to put this one trade on. So that risk is $40, and what we are looking to receive is $165. So our total risk is $38.35 or $3,835. Now, in order for us to lose that amount, that means the market has to go above 2120 and it needs to finish above that at that expiration date for us to lose the maximum on this trade. So if you do the math on it here, the expected move is 140, but we're talking 2120 minus where the underlying stock is at right now, 1818. We're looking at a 300-point move in Google before that expiration date. Now, you do got a few days to trade. The market's going to trade all day Wednesday the 3rd, all day Thursday the 4th, and all day Friday the 5th. So you have a few more days until that expiration date. Ideally, I'd rather do this trade. I like these trades a little better when we were closer, when they usually announce on a Wednesday or a Thursday, but we're going to take what we got here. We're getting a decent credit. We have a wide butterfly, which means we got potential of upside besides that net credit received. So if the market did stop, ideally we would like it to be somewhere between 2000 and 2040, right? If it landed somewhere in there, we'd be good and we wouldn't really be as nervous about it getting to our risk zone. And we could potentially make 4,000 on the opposite end. If it closed right at expiration at 2040 and we rode it all the way to expiration and it closed there, we could in theory make $4,000 plus the net credit received of 165 or $4,165. Now, we really don't want to do that, in that it'd be nice to hit a home run like that. But if we're anywhere close to the 2040 strike, we just want to get out of the trade. We don't want to take that risk. That's a lot of risk here on a 1x2x1 trade. So we would want to close out of it. Our biggest fear is that we gap open more than the expected move, and it pushes towards our short strike almost instantly. And that can happen, especially around earnings on these underlying stocks. So that is definitely a concern, but we're going to try to manage that risk. And if it did open anywhere near that 2000 strike or 2040 strike, even if you're down on the trade a little bit to start with, you just want to get out. You don't want to take that risk. We have 3 different scenarios where we do okay. One scenario is stock doesn't move at all after earnings. The second scenario is the stock actually goes down after earnings. And the third scenario is that it just moves the expected move after earnings, or somewhere a little less than that. That would be all 3 of those scenarios. You should be doing pretty good on your skip strike butterfly in Google. Okay, so one last time on the recap. We're looking at the February 5th expiration. Google is announcing on February 2nd. We're going to buy the 2000 strike call, sell 2 of the 2040 strike calls, and then buy 1 of the 2120 strike calls, looking to do it for a net credit of $1.65 to the account. That's where it's trading at. Ideally, we probably want to look at this on Monday or Tuesday and decide if we still would want to do that trade at that point in time. But that's how I would look at the strikes. I would look at what is the expected move on that day, and then I'm going to go beyond it. And I want to make sure I'm far enough out of the money that there is less of a chance that it would gap open all the way beyond my short strike, because that is by far your worst case scenario. But in this marketplace, what a crazy day. Who knows what can happen around earnings on these are, companies with earnings overall, but there's just been so much noise in the marketplace lately, like GameStop. All right. Well, that's going to be it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. Please follow me at Twitter, handle Brian Overby. And thanks for listening. And we'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.